So moving on to part 2 of this video, I'd like to point your attention here to the secondary basement suite monthly rent. So obviously the more rent you have, the higher your NPV is going to be. But I kind of got this little hook here and then it plateaus. That's for the secondary basement suite. The reason is for 3 bedrooms, I have a maximum rent that I can charge, which is $10.37 per month. It's basically a call option that I'm selling. So this here is actually the formation of a call option. It goes up to a point and then I just have a steady amount. So that's why that there looks steady. These here are called spark charts right here. They're not super useful in terms of figuring out exactly what's going on, but they are useful in kind of figuring out the nature of the relationship. For example, construction rentals. So the lower this number here, the lower the cost of my rentals initially, the higher my NPV is going to be. So it just kind of helps you with the nature of that relationship. So let's go through a couple analyses here. So upstairs monthly rent, let's say instead I make the upstairs maybe a bit of a boarding house. And I rent out the garage separately. Let's say I rent out all 3 rooms upstairs, $500 a piece. So let's put in $1,500 there, and look what happens to net present value and average annual before tax cash flow. Just churning a bit here, so you can see huge increase in net present value, huge increase in cash flow every month. So quite significant. So let's just undo that. Okay, let's say construction rentals. Let's say I go through and I take a look at everything I was going to do for construction, and there's no point going so overboard on the top. I'm spending about 25 grand doing work on the top floor. Let's say I only actually really need to put in, I don't know, say 5,000. So I'm only $30,000 in for all the renovations. Let's take a look now. Huge increase in NPV. But if I'm doing that, the increased property value is probably going to be a little bit smaller. So let's say instead I get about $30,000 lift increased property value. So NPV still significantly increased. Okay, let's just undo both of those. So number of months initially unrentable. So this is a bit of a hiccup with the Cornerstone and even making any suites legal. There's almost no difference between Cornerstone and creating a legal suite. You're pretty much going to end up suffering in any way. Construction renos, okay, that just probably hasn't updated yet. Let's try to get it to update. That's okay. All right, so number of months initially unrentable. Let's say it takes 6 months to get me to rent this place. Okay, so NPV goes slightly negative. All right, so let's go back to 3.5. I think that's probably more likely. So vacancy rate at 2%. I don't know. Let's say it goes up to 5%, long-term, 10-year vacancy rate. Not a huge effect on NPV as we would expect from the spider chart. And you can do that for all of these variables here. Liquidation costs, this is basically realtor fees if I got to do anything to fix up the place. This is an interesting one. This is Cornerstone approved funding. So you could actually punch in the number of 0 here, but it's already actually over here. So let's say I can't get any Cornerstone funding. I'm going to have an NPV of about negative 20 grand. You can see right from there. That's it with no Cornerstone funding. So with the best, most Cornerstone funding I could possibly get. I'm going to be way out there. Okay, so let's run a few other scenario analysis. So scenario analysis, this is basically change a whole bunch of things and see what happens to NPV. So qualifying labor, basically with Cornerstone, they want me to hire people who aren't myself, and they're only going to fund 50% of the work I do if it's not me. But let's say that my labor does actually qualify. I want to see what it does to NPV. Okay, so it goes up to almost $1,000, so pretty significant. So number of legal bedrooms. So the amount of rent that I can charge is based on the number of legal bedrooms that Cornerstone applies. So I have 2 bedrooms downstairs. I might have a third if they're going to accept if I put a little armoire in that closet, which increases the rent from about $900 to $1,000, so significant. Let's say they only approve 2 bedrooms. What does my NPV do? Again, it doesn't sink me. It goes down a little bit, slightly negative, but I'm still probably making 16% minimum. Okay, and I'm going to stop this video, and then we're going to play with some of these more advanced scenario analysis variables. From Suite Zone Properties, I'm going to take you through this model that investigates the Cornerstone program for 8613 39B Avenue. It's currently January 2014. I'm doing this here from Thailand. I'm just outside of Chiang Mai. So there might be a little bit of sound in the background, but I'll take you through this model that I built. First of all, this is a very complex model, okay? So in finance, there's something called model risk, what that means is basically when you get to really, really complex models like this, there's a risk that I did something wrong. So you got to take everything I did here with a bit of a grain of salt. Complex analysis is great because it proves the robustness of your financial plan. It's also not great because you can rely on the model a bit too much and expect it's always true, and it might not be true. So before I manipulate any variables here, I'll just take you over the high level of what's going on. So first of all these blue inputs, you can actually edit them yourself. If you ever get a red input like this one here, the discount rate, don't edit that because it won't actually do anything. Some of them you can edit, and I've kind of made notes along here where you can. Some of them are just scenario analysis. So here, qualifying labor, for example, you can choose yes or no. Same as the number of legal bedrooms, you can choose how many. Okay, so at a pretty high level here, net present value. So why do I use that instead of something like ROI? Well, ROI is basically financial kindergarten. It just is not a very good measure of how much money you're going to make. It's good as a very first brush. I use it when I'm just punching numbers on a piece of paper. But when it comes to actually deciding whether to buy a place or not and whether to go or not go, you need NPV. It's really the same idea. So if imagine an ROI of 18%. If net present value was 0, that would mean that I would make exactly 18%. Okay? So net present value is a little bit greater than 0. So what that means is I make a little bit more than 18%. Cash on cash return on this property, because that's all that I ultimately care about, is the cash. Okay, so let's take a look at the high level. So these ones here, all these inputs here are my best guess of what's probably going to happen in the future. I can't defend every single one of them. All I can tell you is I read quite a bit of economics, and this is what I truly believe is most likely outcome. So going through all of that analysis, after I put in my very best guesses for everything, I come up with a net present value of 95 bucks. So it's not like I'm making 95 bucks. It means I'm making 18% return after everything is accounted for, and I'm still making a little bit more than 18%. So it's actually a very, very strong investment. So let's take a look at some of these things here. So spider chart. This here is all about robustness, okay? It's all about robustness. Number 3, the column number 3, these are my best guess for where all of my funding, everything is going to be. I think this is probably where it is. And these are all NPV numbers. So anytime you see a positive number, that means you're making more than that 18%. Anytime you see a negative number, you're making a little bit less, potentially a lot less. So number 3 is the best guess, 2 is somewhat likely, 4 is somewhat likely, 1 is fairly unlikely, 5 is fairly unlikely. And so just looking at the slopes here, we can figure out what's our probably most sensitive variable. As you can see right there, property value growth. Point number 5 is definitely the most sensitive variable. That's really not surprising because I have a tap out here in year 10 where basically I sell the property and I take my money. Why 10 years? I know it seems arbitrary in finance. This time it's not. It's because with the Cornerstone program, I have a caveat from the city for 10 years where if I sell it, I lose my grant funding. So I don't want to sell before 10 years. I got to hold it for at least that long. And basically what this here is based on is, so I got property value. So what kind of expected appreciation? I said 3.5%. I think that we're in for a very strong economy in the next couple of years. And beyond 3 to 5 years, I'm completely guessing. But you know what? It's Alberta. I don't think you could invest anywhere better in the world. Other than some austerity measures in Europe, the world economy is improving here in 2014. Almost everyone thinks so. At bare minimum, even if things go fairly poorly, we're looking at inflation for the next foreseeable future. Yes, we could have a price production and a collapse of values, but I have a sensitivity analysis if things ever did go wrong, and we can take a look at that later. This here's called a tornado chart. So this is the absolute worst case. You'll always see that to the left of what I think is potentially possible. And on the right-hand side, this is what I think is probably the best case of what's really potentially possible. You see the bands here are really simple. One more thing. Oh, I'm going to stop it. So now for a few more advanced. So refinancing, after Y years for X amount of dollars. So any broker is going to say, oh, you can't refinance if you don't have at least 20% down in the property. And that's true for rules today. But keep in mind, like, there's other ways to get money. Like, let's say I get a line of credit that's secured against the property, and even though I got percent down to maybe 5%, maybe even 0, I can still pull out equity. So, I mean, creative solutions, right? So this is kind of an interesting thing. It allows you to refinance, choose how much you want to refinance, and you get to choose what year, and then it'll tell you what your NPV is after that. So let's say I can refinance for 50 grand, and let's say I can do that in year 5. You can see everything kind of adjusted here. Okay, NPV is now at 12 grand, and yeah, it basically also accounted for the fact that when we sell in year 10, we're going to get 50 grand less. I didn't account for time value of money in that, just to preserve my sanity. So this is a little bit aggressive, but probably not unrealistic. Maybe knock a grand off of that. But you can see all of these variables here much more favorable. Look at construction rentals, far less sensitive. Property value, far less sensitive. All these NPVs here are positive now. Look at my worst case scenario. I'm going to lose 5 grand if I can pull out that much money, and I still have 5% down. That's just taking out some equity. So kind of an interesting analysis you can do. Now let's say something bad happens. Let's say a tenant damages the property. Choose what year it happens in. So the further in the future the tenant damages the property, the less cash flows will be penalized. But let's say I get $30,000 of tenant damage. Let's say my insurance won't even cover it. That happens in year 2. You can see it's now a negative 20% NPV. So that one really hurts. But let's say that one happens in year 8. All of a sudden it's negative $8,000. So you can play around with that. Now let's say there's a huge devaluation in the real estate market, because that actually can happen. Now you're never obligated to sell. Remember, this is still a positive cash flow property, so I'm not obligated to sell. But you know what? Circumstances can happen where you do have to sell, and it's good to see what that risk actually looks like. So let's say there's a devaluation in year 10, and let's say it's a 30% devaluation. Okay, so there's the liability. It'd be about 30 grand. You can see everything here are all very negative. All these inputs are very negative. Everything, you're basically getting into the ball game just to lose money. All of this negative, 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 negative. So you never want to get into something if you think there's going to be that much of devaluation. Let's say there's a 10% devaluation. Again, 10 grand is the NPV. Not very many scenarios here that are optimistic that result in good value. You're only really going to get value with property growth. If you're not very risky with CAP-M, if your renovations are cheaper than what you expected, so too risky of an investment. So let's say it's a 5% devaluation. Okay, looking a little bit better. A little bit better. We have some more positive situations. But yeah, that's basically what you can play with. And I'll just show you the bottom part here. So I made assumptions when it came to the spider chart and tornado charts. But you can change anything here that is in the blue cells. So let's say increased property value after rentals. 50 grand is what I thought it would be worth. But you can change all of these assumptions and it'll dynamically update. Same as for the tornado chart. You can change these and it'll change everything. Same for this other smaller spider chart here, which is only for market rents. So that's the basics of this model. I could go through the other steps, but you know what? You can probably figure it out yourself. I just wanted to show you more or less how the whole model works. Thank you very much. This version of the model is posted online. It's open source. There's no protection. So if you want to change anything, look at it, go at it. But like I said, there is model risk. It's a very, very complicated model. So just use it at your own discretion, and I highly recommend you do a simple analysis. So thanks a lot. Have a great day.